Well, the Biden administration is now proposing or about to propose some pretty large new electric vehicle rules. Easiest thing to do here is pop on over to the New York Times and see exactly what this sort of pre leak is regarding electric vehicles. Take a look at just the headline here. EPA set to propose rules meant to drive up electric vehicle sales tenfold in what would be the nation's most ambitious climate regulation. The proposal is designed to ensure that electric cars make up the majority of new auto sales by 2032. Right now, electric vehicle sales are closer to maybe 5-6% of total sales. Now, keep in mind, this is really important to remember, and we'll want to see if this is related to this. But the Inflation Reduction Act gave us somewhere around, let's call it $389 billion for energy related items. However, Goldman Sachs believes that that number is actually going to be a lot closer to about $1.2 trillion via the Treasury Department simply interpreting rules more loosely in favor of the Democratic agenda. So let's see how much of this New York Times piece relates. Let's see. Biden administration is planning some of the most stringent rules on auto pollution in the world to ensure that all electric cars, note not hybrids here, make up as much as two-thirds of new passenger vehicles sold in 2032. A lot of companies, by the way, talking about banning electric vehicles, banning non-electric vehicles by 2035. California is one of those. New York, I believe, is another. Anyway, that would represent a quantum leap for the United States, where just 5.8% of vehicles sold last year were all electric, and would exceed Biden's earlier ambitions to have all electric cars account for half of those sold in the country by 2032. That's because now he's trying to get up to 67%. So I'm curious to see how they're planning on setting this up. Take a look at this. The administrator of the EPA is expected to announce the proposal limits on tailpipe emissions on Wednesday. So, in other words, this would simply be some administrative rule, not a rule that is passed by Congress, but rather some form of administrative rule on emissions and how green vehicles need to be, which essentially would drive people solely into electric vehicles in order to make them compliant. It was originally set for Detroit, this meeting on Wednesday. The requirements would ensure that electric vehicles represent between 54 and 60% of all new cars sold by 2030, rising to 64 to 67% by 32, said people familiar with the matter. Rapidly speeding up the adoption of electric vehicles would require other significant changes, including millions of new electric vehicle charging stations, an overhaul of electric grids, and the minerals and supplies for batteries. Now, the neat thing is the Inflation Reduction Act does exactly this. These items that are listed here are essentially enabled by the Inflation Reduction Act. And so, to some degree, you have the political game that's being set up. I mean, think about the political game. The political game is simple: convince a bipartisan measure to pass on green energy. That's sort of step one. We got that, right? That's the Inflation Reduction Act. I should say, ensure that act includes leeway for the current administration, which in this case, obviously, is the Biden administration and Biden's EPA, and then allow that leeway to stretch the existing budget via the IRA, which is what Goldman says, which Goldman predicts will be a 3x. And so, in my opinion, what's fascinating about these rules is what you really have is you have a game of almost what looks like 4D chess in preview, but in hindsight, totally makes sense. So then, step four, have your democratically controlled, or I should say, Democrat controlled departments create strict rule sets that require more Reduction Act leeway, right? Because basically, if the EPA comes out and says, "Hey, we need to get to 67% by 2032," you know what that means. So the example, right? Pass a small bill with leeway, then implement strict rules. Now, Treasury has to go super strong on leeway side to enable those strict rules. So, in other words, the money's already there. You don't even have to go to Congress to create more money for what they need here, which are, again, significant changes to millions of new electric vehicle charging stations. Think about what the Biden administration has already done. Hey, Elon Musk, can we partner with you? And can you build us thousands of more electric vehicle charging stations? And we'll pay you billions of dollars to do that. Of course, the answer is going to be yes. An overhaul of electric grids. And that's fantastic potentially for megapacks as well for Tesla, right? Which we just heard about that new Shanghai expansion for megapacks that could create as many as 10,000 megapacks. And then, of course, helping with battery materials. The proposed regulation would go through public comment and could be altered by the government before becoming final to make sure it meets legal challenges. It could become an issue in the 2024 campaign as a future administration could undo or weaken it. Notice here, they don't talk about Congress because Congress has already been authorized, or the purse strings have already been authorized via right here. The new regulations come on the heels of the 2022 Inflation Reduction Act, which has helped stoke demand for electric vehicles by providing the tax incentives we've seen, as well as incentives for battery manufacturing and critical processing and mining. And there's been nothing that's been made more of in America right now than factories in 2022. That's something that's pretty incredible to think about. We was reading a report on this yesterday, and it's a worthwhile argue or point to mention that in 2022 we saw about 120 billion dollars. Well, actually, it was closer to 80, 108. It was 108. Let me see if I can pull up my note. 108 million or golly, Kevin, $108 billion. Oh, I got it here. $108 billion of construction related spending in manufacturing. Uh, that contrasts to the next highest level or compares to the next highest level in 2015, where we spent about $83 billion, which means we spent somewhere around $25 billion more on manufacturing. This was according to the Wall Street Journal. We spent more money on manufacturing than we did on building schools, healthcare centers, and office buildings. Much of that growth was focused on EV, tech, batteries, semiconductors. That's because that's where the stimulus checks are going. Only 10% of the private workforce right now is actually in manufacturing. However, the sector still is behind on a level of employment by about 800,000 jobs. So if you're looking for more growth, the growth is likely to be manufacturing. Look particularly here at this chart on screen now. Construction spending related to manufacturing. I mean, we've blown out of the water the previous sectors here. Now, what's also pretty incredible though is how much these factories are automating these new modern factories. Stanley Black and Decker gave us an example, and they said that their automated lines used to have between 50 to 75 people per line to make power tools. Today, those factories only require about 10 to 12 people. And in the future, Stanley Black and Decker expects that only 2 to 3 people will be required per line on their manufacturing plant. I mean, that's a decline of 95% of the amount of labor that's required in manufacturing, which is pretty remarkable to think about. But what it really suggests is that you probably don't want to be investing in labor, not that you directly would invest in labor anyway, but what you probably want to do with this expansion of factories, is do whatever you can to find out how can we make sure that you are exposed to companies that are building these manufacturing plants and are getting these massive stimulus checks. And let's see, we talked about this. Let's look at the rest of the article here from the New York Times. Transportation is the largest source of greenhouse gases. Okay, why are we having some HDMI problems again here? Anyway, the proposed auto emissions rule is even more demanding than the target laid out by Mr. Biden in 2021. Speaking on the South Lawn, that was back when he was talking up the Ford F-150, fine, whatever. Climate change experts say that the transition to zero-emission vehicles must move faster to avoid a planetary disaster. So they could just go into why, basically. Proposed rule would not mandate electric vehicles make up a certain percentage of sales. Instead, it would require automakers to make sure that a total number of vehicles that they sell each year did not exceed a certain total emission vehicle limit. Oh, that's interesting. It's one way to do it. Basically, it puts the onus on the companies, not on the consumer. So it makes it a little easier for consumers. So in other words, consumers could still buy an ICE car, but there will start being some restrictions on. I would imagine a way a manufacturer could do that is they could just raise prices on the ICE cars to limit some of the number of sales there while maximizing their profit, and then lowering the costs on electric vehicles, which that's basically what this bill does is it drives up the cost of ICE vehicles and down the cost of electric vehicles. Even manufacturers that chafe against the regulations would prefer to deal with one set of rules rather than meet specific rules from a bunch of different states. Like here's that California line about banning by 2035. One of the biggest items needed for electric vehicles is charging stations. 2021 infrastructure law provided $7.5 billion to build a new network of about 500,000 charging stations. Yeah. So, pretty incredible that basically these massive stimulus checks are coming to the electric vehicle world. Obviously, I think that's a boon to a company like Tesla, but it'll also be a boon to companies like GM. GM has a fantastic Ultium partnership with LG to make batteries. They're building a pretty large plants, actually multiple sister plants in Ohio and Tennessee. What's crazy is how much money, just to give you an example of how much money is going into some of these plants. Uh, if we just Google, just for giggles, the cost to build a factory, usually you look at a cost to build a factory of anywhere between $5 to $15 billion. Let's just say for giggles, we'll take the average. We'll take the number of about $10 billion. Well, GM and the LG partnership just got a federal loan, which is super sweetheart deal of $2.5 billion, so about 25% of it. The rest they can get commercially. And then they're getting about $666 million in state grants and bargain electricity rates to actually operate those plants. And so what's remarkable is you're seeing governments at every level and the monopolies at every level, whether it's the electrical departments, the cities, the counties, the states, the federal government, everybody's throwing money at these factories. And it's not just going to be a company like Tesla that succeeds. It's probably going to be the chips manufacturers. It's probably going to be your chip related companies like the chip equipment manufacturers, the companies that actually take in those chips and use them, like Apple, for example, by taking the chips and turning them into a consumer product. But it shows you how much money is just flowing in. It is quite remarkable, and how they're pulling it off. Now, there has been some chips weakness over the last couple weeks in terms of a trade that's worth paying attention to. For example, if we look at Goldman Sachs on chips, this is a piece from Goldman Sachs on chips. Let's make sure we go ahead and have this screen up here that reminds you about the expiring coupon code in 2 days on CPI Day. Prices will be going up for those programs on Building Your Wealth. Link down below. You get lifetime access, and you can now buy now, pay later to get access to them, lifetime access to them. You pay as little as $30 a month, which is pretty cool. You instantly get access to those course member live streams. So take a look at this. Hedge funds net sold tech stocks for the third consecutive week. And if you look at just semis specifically, this is a long, they call it an LS chart, long short ratio chart. And basically, the higher the level, the more short, or sorry, rather, the more long in this example, the more long hedge funds are. And the lower the level, the more short they are. And what you can see is hedge funds went into 2023 extremely bearish. And they came out a little bullish there around February, but have already started selling off again. However, look at how uncrowded the semiconductor space is right now, which happens to be where the majority of the stimulus checks are rolling. And look how uncrowded it is. The long short ratio is basically even. We're basically at a 1-to-1 ratio here. In other words, for every dollar that somebody is long right now, somebody's short on semiconductors. Now, look, I understand there's been some news that hasn't been the greatest regarding semiconductors and PC shipments and what's going on with Apple. For example, Apple personal computer shipments declined by 40.5% in the first quarter. This is per Bloomberg, quote, marking a tough start to the year for PC makers, still grappling with a glut of unsold inventory. That compares to Dell, which looks like it's down about 30%, HP down about 28%, overall market down about 30%, Asus down about 33%, Lenovo down about 33% as well. You've got, let's see here, Apple shares down about 0.8% in pre-market when this article was written. Even with heavy discounting, channels and PC makers can expect elevated inventory to persist into the middle of the year and potentially into the third quarter. The silver lining is that cooling demand is giving manufacturers time to make changes as factories begin to explore production options outside of China. That is true. You are starting to get sort of this what I call re-globalization. A lot of people during the post COVID era were saying, "Oh, here we go. We're going to get deglobalization, and we're going to get massive inflation because of that." I don't think so. I think we get re-globalization, and we actually get even more efficient supply chains than we've ever had before. TSMC also this morning announced that they missed sales estimates for the second consecutive quarter in a sign of continued weakness in global electronics demand. First quarter revenue for the world's biggest contract manufacturer of chips was 16.7 billion. That's a sharp slowdown in March. Sales were down 15% last month relative to the prior year. Companies listed shares down about 1.1% in pre-market. Global PC shipments crashed 29% in the first quarter, led by Apple's Mac lineup. Apple's Mac lineup, the one that is actually leading the decline. Now, Apple's iPhone, iPad, and wearable segments have been doing better than the Mac line, but something to pay attention to, especially if you're an Apple investor. Now, what I think about this, and we could just sort of just quickly look at the market too. Let's see how they've moved. TSMC pre-market right now down about 1.54. AAPL pre-market right now down about 1.3. So what I would do is I would pay attention to see how these stocks move today on these basically pre-announced sales weaknesses, because I think what these companies are doing is they're providing you the bad news now, and then that way when earnings come around, the expectation is already set, and it's actually a lot easier to beat on your earnings report by pre-releasing the bad news. And the pre-release bad news is only moving these stocks about 1 to 1.5%. It's probably because so many people are already short these chip and tech companies. So I actually find that a big element of I see a lot of optimism in that. I love that. There's so much of a short play in the chip sector right now, because when we combine that with what we're expecting to see with electric vehicles, which require a lot of chips, superchargers, chips, pretty much anything tech related, chips, 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 chips. And this is where the stimulus money is going, not only via directly this CHIPS Act, but also the Inflation Reduction Act and the manufacturing economies of scale that we're expecting to see here in America. Yeah, I think in 10 years from now, we'll look back and go, how could we have not bought chips and electric vehicle stocks? It's going to be remarkable. So that's my take. If you want more of my take, make sure you join those courses on building your wealth, linked down below.